Hey everybody, and welcome to the Solidity Insurance Group team call. My name is Marisa Maggio. Today is March 20th of 2025, and I'm super excited as we have a really special guest on with us today. We have Devon Martin with National Life Group on with us, and this is somebody who, even prior to being our rep, I can remember calling into National Life Group, and Devon would help me with illustrations. He would help me with a lot of different things. Devon probably doesn't even remember that, but you've helped me in a lot of ways, directly and indirectly, so I appreciate you. But Devin, how are you doing today?
I'm doing well, Marissa. How are you?
I'm doing absolutely amazing. I appreciate you being on the call and taking the time and kind of just to hit it off, Devin, what kind of is your agenda going to be today, kind of as we walk through?
Yeah, it's honestly, I love for my things to be more of a conversation than a presentation. I was going to cover why NLG over the other 730 plus insurance carriers, quick tips and tricks on how to get paid faster with us and how to submit business, and then really any questions or even complaints or maybe some compliments that you guys had as well.
Absolutely. That sounds like a great agenda, and we'll definitely chime in. So, guys, as we're going through this, if you have questions, feel free to unmute, be involved. That's the point. That's why Devin's on with us today. So, thank you, Devin.
Put the questions in the chat, guys.
It's my pleasure. So, really, thank you all for being on. And I know that you guys can have any carrier rep on your call, and I won't take that for granted. And in that same breath, I won't take for granted any applications you submit to the company because I know you could submit a lot of other carriers as well. So, I first want to say thank you again, because when I first became your rep at National Life Group in 2019, when we partnered together, we did a whole $100,000 in production, a whole 100,000 for the whole year. Last year, we finished at $30 million together. So huge growth within 5 years, especially on the recruiting side too. So, hey, Zach, I'm doing a training for FL. Can I call you back? Okay. Okay. Sorry, Zach. I always answer Zach Tradowski's call without question.
That's fair.
So, like I was saying, so huge production, and honestly, I couldn't be more grateful, but it's just the beginning. So I don't think anybody's more excited than me or National Life Group with the switch that Family First Life is doing. And what I mean is everyone's talking about IULs. I'm trying to do IULs now. IULs, the Index Universal Life Insurance policies. National Life Group is number one every quarter, every year with those solutions. And it's not just for one reason, it's for multiple reasons. So, again, what I'm going to cover in this call today is I'm going to cover why you would sell us, where we kind of fit in the market, any questions that you have, underwriting, living benefits, and then maybe potentially how to structure those policies. The illustrations can be a whole hour plus of a training, so we won't do those alone, but I can come back and do another training for you as well. So, why National Life Group IUL? Why? I mean, I kind of tell this story a lot, but a few years ago, I was sitting down with one of our executives and a longtime agency owner with us. And we were sitting down, and the agency owner was talking about how much he's been recruiting. And he said, I can't stand that when I'm training my recruits, it's an uphill battle when I illustrate National Life Group. And we said, well, what do you mean? He said, there's about four or five other carriers that illustrate higher cash value than you. But then he followed that statement up by saying, I love that I've never had to go back to a disappointed client. And what does that story really mean when we double click on that? It means that we hold ourselves to a high integrity when it comes to our renewals. So we're one of 7 or 8 companies that I know of that actually publish our historical interest rates inside of our website. Quite honestly, I don't know why 2 of the 7 carriers do because their rates are so bad, but we're the number one selling IUL carrier every year. One, because of our rates, as I just said. The other is our submission to commission. So we've been around since 1848. And by the way, whenever I do these presentations, I always think about what's in it for you as the agent. So everything I'm saying should help you in your sales practice, and you guys should have some good nuggets as a takeaway. But back to what I was saying, we've been around since 1848. If you think about the events that have happened from now until then, from then until now, rather, that's world wars, stock market crashes, Great Depression, COVID. In the beginning of the pandemic, our company went from $2 million non-medical to $3 million. So we increased our non-medical by $1 million in the middle of COVID, while other carriers were scrambling just to see what they can do to sustain. So we thrived throughout COVID. We didn't just survive. The other thing is our living benefits. We paid out $113 million in living benefits alone last year. You'll never hear me talk badly about another carrier or anything, but I will brag about us where we are the best, and it is the living benefits. We're in all 50 states, all of our policies, even our term products, and we have the highest minimums. So some carriers could be in California, but maybe their maximum payout isn't as high as ours. And we paid out $113 million in living benefits alone. And honestly, it's the speed to issue. So we will talk about that. But my biggest ask is that you don't compare IULs to final expense. They're night and day different. Okay. So again, you'll never hear me talk bad about another product. I'm just saying that IUL is completely different. So 30 to 35% of FFL's policies never touch a physical underwriter. If you are experiencing that, it's because of how you're filling out the application. How you fill out the application is just as important as the health of the client. Again, when you sell a new carrier, you know the game, you know the sport, you're just playing for a different team, right? And I'm going to show you guys the playbook of our company. So that's kind of the layout of what we have together for the next hour. Any questions or comments before I move on?
No, I think that that's awesome. And the fact that 30 to 35% don't go to underwriting is huge, but also shows me that we as agents can do a better job too in our process. So excited to hear about it.
I'm glad that you said that because we're going to have a locker room conversation a little bit as well. So, and just so you know, whenever you ask a question in a presentation until you receive something back, it's about 6 to 7 seconds. So I promise it won't be an awkward silence longer than 6 or 7 seconds. I promise you. But moving forward, thank you. Here's our company. Here's our benefits. And one thing I'd like to say, we paid out $3 billion in promises last year. So a carrier is really only as good as its claims, right? And we pay our claims. So we paid out $3 billion. We're in sales, so I'm going to round up. We paid out $3 billion in promises. That's loans out of those IULs. That's death benefit payments. That's living benefit payments. That's really everything that we really hang our hat on at the company. So again, why are we number one? It's because of the renewals in IULs. It's because of the renewals. It's because we actually do what we say we're going to do. It's the living benefits and it's the submission to commission. So I oftentimes get questions, how do I start with IULs? What do I do? Quite honestly, and as they say, 90% of failures are because of a lack of system. Thankfully, you guys are with Family First Life. You guys have the perfect system in the industry, hands down. You have the leads, you have the training, you have the leadership. I personally, if I can be blunt, I wish that you guys did a better job of asking for referrals. We will talk about that in a second because there's no better lead than a referral. And it's not as simple as saying, hey, can you refer me to your friends and family? You got to dive a little bit deeper, but we will talk about that. But what I was saying is Family First Life has the system down for you. And this is why IULs are getting more and more popular within Family First Life. It's because of profitability. You can sell a fraction of the policies with IULs compared to your final expense market. And I have to say this again, I'm not talking about final expense. There's a need for it. But you can sell a fraction of them and make more, if not the same amount of money because of persistency and profitability. These stay on the books and people continue to pay their premium payments. So getting started, this is the perfect icebreaker. I don't care if you don't know how to spell IUL. I don't care if you do millions of dollars in production. This is the perfect icebreaker and the perfect talking point. So when you're sitting with clients, Mr. and Mrs. Client, can you agree that these three pieces are the top financial consumer concerns in the financial industry? Die too soon. Is it a problem for you and your family if you were to die too soon? Of course, the first thing people think of with life insurance, a death benefit for my loved ones. Become ill. One of my favorite phrases in what we do is that the only thing more expensive than actually dying is surviving an illness. So cancer, heart attack, stroke, all those everyday events. Live too long, the number one fear for people at retirement is outliving their money. People are living longer with medicine, technology, but I've yet to meet somebody that says, I have way too much money saved for retirement. So, Mr. and Mrs. Client, if I can show you a way to solve all three of those, is that something that you'd be interested? And then, boom, you go right into the illustration. The thing that I think I get the most compliments about at the company is probably our illustrations. Our illustration report is extremely consumer driven. There's a lot of pages in there that we have to include because we legally have to, but I think that it's a really, really good tool for you guys as agents. So the biggest thing, if you're thinking about getting started with IULs, is knowing the illustrations. Once you know those, you're 90% of the way there. When it comes to the illustrations, you don't need to be an expert. The best salespeople and the people that do the best aren't really product experts. They're just good with people. That's it at the end of the day. We're in sales. If you're selling shoes, suits, watches, people buy from people they like and trust, right? But the biggest thing with IULs is knowing how to structure them. Knowing how to structure them is just as important as anything else. And at the end of the day, the two biggest ways you can screw up an IUL is this. The first one is if you build the death benefit so high and the client isn't funding it enough and the policy could lapse. So if you picture a seesaw or a scale, one side you have death benefit, the other side you have cash value. The less death benefit I have, the more cash value I'm going to receive. It's pretty straightforward. Either agents don't know what they're doing or they do and they're greedy, so they try to drive their commission. Try not to solve your problems, make sure you solve the client's problems, right? So the biggest way to screw up an IUL is that, or meching it, which is a conversation in itself. The second biggest way that you can screw up an IUL is if you don't sell it with National Life Group. That's the other big, big mistake you can make. So that's the puzzle piece in a nutshell. I do want to talk about living benefits for a second, and we're going to really, really spend some time on this. So this isn't too good to be true. My company paid out $113 million to people while they were still alive last year in their year of 2024. And you can do whatever you want with the money. You can collect your claim. You can take care of yourself with medical expenses. You can do some bucket list trip items if you want. You can do whatever you want, but there's no restriction on how you want to use the policies. And honestly, it's one thing for me to talk about it, for you to see it in a brochure. It's another thing when you have clients that it's literally saved their life and they're here to tell the story. So on the bottom right there was an agent with us. His name was Richard. And Richard was is a very, very successful agent with us. So years ago, he was diagnosed with cancer. He went to his doctor, and the doctor said, "You have about 2 years or less to live, 2 or 3 years. I recommend that we start you on chemo immediately, and we'll see if we can stretch out your time a little bit longer, and basically give you that care and treatment." What Richard did was he exercised his living benefit claim with National Life Group. He didn't have to worry about any of his finances. All that was covered because of his living benefit claim. He had money, but who wants to touch their retirement and all that funds, right? So what he did was he got multiple opinions. This dude flew to the Mayo Clinic, he flew to Houston, he flew to California. He really, really got multiple opinions. One of his last meetings with doctors, there were six of them sitting in front of him, and they were all getting together, giving them their opinion on what he should do. They all kind of came to the agreement that chemo is his best shot, and they gave him a referral on where to go. At the end of that meeting, one of those six doctors walked up to him and said, "Look, I have a massive amount of respect for my five colleagues. With all that said, I don't think you should start chemo. If you start chemo, your life expectancy will significantly decrease and you will die." Richard followed that guy's advice because the doctor had another rare treatment that he recommended, something very specific. Richard went and took that treatment. He's still alive with us right now, and he has normal life expectancy. So he told that story for about an hour, and literally everybody in the room was tearing up. But that's just one of many of these testimonials. Because again, I know that the cash value in IULs are great. IULs are great because they're tax free. 7702. That's literally the tax code that makes IULs tax free. So for people that say, "Oh, I don't need life insurance, I don't want life insurance," the fact that it's life insurance is what makes the death benefit and life insurance cash value tax free. But you can't forget about the living benefits. These things sell, which leads me to say, my advice to you is not to be transactional. Don't just treat every client the same. I have seen agents on calls where clients could be talking about how their mom had cancer or their brother had a stroke, and the agent is sitting there trying to sell them on tax-free retirement. Not every client's going to be the same. So make sure you kind of dial in and find out what their needs are. But that's living benefits in a quick summary. Are there any questions from you guys? How they're calculated, how they work, explanations on each one? I want to hear from you. Any questions on the living benefits?
One question I think a lot of agents, always come to me with Devon is, if the policy's for 100,000, just to pick a nice even number, and they're in this predicament, the living benefits, will they have access to all 100,000?
No, it is a discounted death benefit. If I give you $100,000 right now, that is much more expensive than me giving you $100,000 in 10, 20 years. Thankfully, our illustration tells you what time it is, not how the watch works. You can see what the projections are. Keeping it very simple, The more the severe, the higher the payout. So terminal illness, that's if you have 2 years or less to live. So I'm not going to give you a percentage, but usually that's anywhere between 80 to 90 plus percent, right? But with critical illness or critical injury, I could have a heart attack and be up and walking in a couple of weeks, or I could have a heart attack and need triple bypass surgery. So the more the severe, the higher the payout. But no, the only way to get the full death benefit is to basically die. That's it.
Perfect. That answers my question there.
Yeah.
And Devin, I have a quick question for you, my friend. So,
Yeah.
regarding the critical injury, can you explain the difference between that and the chronic illness rider? As some agents, they kind of get a little bit confused with the 2 out of 6 activity of daily living, and they would kind of get those a little bit mixed up. Do you mind breaking those down a little bit and explaining the critical injury aspect compared to the chronic illness rider?
Let's do it, man. So, chronic illness is the only rider that's not a lump sum payout. So, that one is a set percentage. You get 24% of the discounted death benefit. So, chronic illness, I can't do 2 of my 6 activities of daily living. Very similar to long term care, but it's not the same. Dressing myself, bathing myself, traveling, controlling my bowel movement. The other two that I usually forget. If I can't do 2 of those 6 activities of daily living for at least 90 days, I get my payout. Let's say that after a year, I'm able to do 2 of my 6. I don't get the payout. I have to requalify every year. Critical illness, that's the one that we see the most. That's your cancer, heart attack, stroke, Lou Gehrig's disease, X, Y, and Z. Those have about 15 plus triggers. Again, terminal illness is the highest severity, so it's the highest payout. All the other ones are lump sum. So I'll give you an example. And this was an actual claim. And Rami, I'm sorry, brother. If I didn't explain that well enough, just hold me accountable. But there was a client and they had $1 million death benefit with us. And they they didn't exercise, but they filed for their terminal illness payout because I think they had 4 or 5, 6 months less left or less to live. So they filed their claim. I think the company was going to give them like $860,000, something like that. They went to their family and said, do you want me to take out this money, the $860,000 right now? Or do you want to wait for me to actually pass and then you guys get the full $1 million? So I tell that story for a few reasons. They're flexible. You don't have to take them unless you want to. You can even take a portion. So in that example, the client could have taken $430,000. They took 50% of their death benefit. Now the remaining death benefits can be 500,000. But if you take the full amount of the living benefit, your policy does terminate. So if they took the full amount, there would be no remaining amount. So education behind these are pretty severe because our claims sent us something the past few years of top 10 calls that were not claims. No exaggeration. People were breaking their fingers and having lower back pain, and they were trying to get a living benefit claim. So these are significant critical illnesses and critical injuries.
That answers the question, I
Thank you,
think,
bro.
Devin. That was deep dive. Appreciate that. Seriously. That was
Oh
great.
yeah, chat box. Sorry guys. Fire emojis. Put that question in the chat. Lapse concept. Okay, yeah, Liz, good question. So lapsing your IULs, basically the cash value and the premium isn't sufficient to keep the policy going. So all IULs will lapse on a guaranteed ledger. I don't care who it is. I got my IUL when I was 23 years old. I got our highest rate class. I'm max funding it. It was going to lapse in my 60s. That's what those anti-IUL agents or people hone in on. But that's worst case scenario. That legitimately, the world would need to be worse than it was during COVID. And it has to be a 0% or down market every day, every year. And your insurance carrier legally, as high as they legally can, increases the cost of insurance. We've never increased the cost of insurance on our existing books of business. National Life Group never has, which is really, really strong to say, right? But at the end of the day, Liz, what I was saying is people tend to design the death benefit really high, probably for a commission play, and then the death benefit is too high and the client isn't paying enough premium for their insurance, so it's going to lapse. So there's going to be no more coverage. But again, if you design them with minimum death benefit, max cash value, then your policies generally should be okay as long as your clients commit to paying that monthly premium. Good on living benefits. We're going to talk about underwriting next, all insurance agents' favorite topic.
Let's do it.
All right. So, National Life Group, we don't require our clients to have social security numbers. So you can have a tax identification number and still get a policy with us. You technically don't even need to live in America to get a policy with us. However, you can't just visit the country once and apply. You got to have some sort of nexus. Do you own a business here? Do you pay taxes? Do you own property? So on and so forth. Do you have money in a United States bank account? Keeping it very simple, what we consider a foreign national is anybody that lives outside of the country for 4 months or longer out of the year. If you live in America 8 months or longer, you're considered a U.S. citizen. Obviously, this is a huge gray area, right? But generally speaking, those are the general guidelines. So that's foreign nationals in a nutshell. So 4 months or longer outside of the country, you're considered a foreign national. In the country longer than 8 months, U.S. citizen. All right. This next section is probably going to be the most important section of the day. So if I left my job and I joined your team right now, this is probably the information I would want to know the most whenever I'm going out into the field and selling. Not this slide necessarily, but the next ones to come. There's multiple ways to sign our applications, by the way, and there is two parts. Nash Life Group application is a little bit longer, but the reason why, one is because we have the best product, and two, because it can potentially instantly approve. So we actually start underwriting as you're filling out the second part of the application because the client signs off on HIPAA and gives us the ability or the authority rather to do that. If you click email, it's going to go to the client's email. The policy is going to sit there, and you can't even complete the second part of the application until they sign off. If they're in front of you, you can do face to face. If they're not in front of you, technically you can't. Technically you can't. But we have this text option now. Click this over email every single time. It's going to be so much faster. So these are our instant approval non-medical guidelines. I would almost print this out and hang it up on your fridge. Like, have these memorized. So we instantly approve, and it's the application only under these guidelines. It is not a guaranteed issue or simplified issue product. It is still technically fully underwritten, but that works in your favor. How does that work in the client's favor? They can still get preferred or preferred plus if they qualify. So if your clients wanted to go through a paramed under these guidelines, they actually can't. If they wanted to, they still can't. Keep these in mind because let's look at this for an example. Let's say you're designing a policy for a 62-year-old. You design the illustration, the death benefit solves from a premium, and it says $260,000. You obviously don't want to underinsure people, but that $10,000 is the difference maker of them not having to do a paramed and having to do a paramed. So make sure you keep these guidelines in mind. And if you try to change your mind in that situation, it's a red flag for an underwriter. So please make sure you have these in mind. So 66 and older, always going to be a paramed, right? But these are the instant approval non-medical guidelines with National Life Group. This right here is why policies don't instantly approve when they should. I probably talk about this more than I talk about anything else when it comes to National Life and Family First Life. So this right here is why policies don't instantly approve when they should. I have another email I'm going to pull up in a second for us, but these are the big things. This one actually isn't even on the screen. You guys buy a lot of leads. There's a question on the application. Insurance carrier activity. Have you applied with another insurance carrier? Let's look at this situation. I'm selling a policy to a client. I'm filling out a National Life Group application. Mr. and Mrs. Client, do you have any other insurance or have you applied to another carrier? If they applied, let's say 4 months ago, and they didn't accept the policy, you still need to disclose that. You still got to disclose that to the company. If you don't disclose that, it's going to have to touch a physical underwriter, and you're going to have to communicate with them, and then they'll go to probably approve the policy if they can. But if you disclose it, it helps your chance of getting an instant approval. I said it earlier. The more information you disclose and the better you fill out those applications, the higher of a chance you can instantly approve. You could have the healthiest client in the world, or you could have a client that can instantly approve. And if you don't fill out the application well enough, it's not going to. The other big reasons are attachments. Don't ever include an attachment in the application. I don't care if the e-app is telling you to. Don't ever include an attachment. Common question when I say that, what about the illustration? You should always be going from the illustration into the e-app. There's literally a button that allows you to spit all the information in there. Death benefit, riders, sex, age, everything. If you click that button, it considers the illustration signed in a majority of the states. So the other big things, don't free type the medications. So the medications are hard to pronounce, let alone spell. When you start to type the name of a medication, it's going to filter and you need to physically click the name. If you don't physically click the medication, it's like you never disclosed it. Other thing, always include the doctor. Unless you have health issues or you're 60 and older, we don't care if you have a doctor. I'm going to say that again. Nash Life Group doesn't care if you have a doctor unless you have health issues or you're older than 60 and a child, but you have to put something in there. When in doubt, fill it out. If they truly don't have a doctor, put their urgent care doctor down the road when they last sprained their ankle or anything happened. Always include the doctor. The other thing is children. Don't eyeball children. If the mom or dad said, oh, yeah, they're about 60 pounds and 70 inches tall, be accurate to the inch and to the pound. That's a big one. So that's why policies don't instantly approve when they should. If you guys do that, you should get more instant approvals. But I can confidently tell you, if you're not getting a lot of instant approvals, it's because you're not disclosing the information. And I totally appreciate the fact that buyers are liars. I totally get it. But if I'm filling out an application and every single health question was answered no by the client, pause and ask them, are you sure you didn't get a speeding ticket? Are you sure you didn't have medication prescribed that you don't take? Even if they don't take it, but they're prescribed, you still have to disclose that to us. So the more information you disclose, the better it works in your favor. So I'm going to pause. I know that was like drinking water out of a fire hose, but that's the most important content right there.
That's huge. And Devin, I think just to be really transparent in the industry, it's usually like, I don't want to say normal, but almost like a norm to include less. And what I hear you saying is now including more is going to allow you guys to get the decision instantly. It's almost like the way I look at insurance is like they're going to find out anyways, the company, right? It's like it's important, guys, that we're giving them all the information on the front end, just like Devin's saying. That way your business isn't sitting in underwriting. So when in doubt, fill it out. I love that, Devin.
Yep, it is huge. It impacts you more than anybody else. I mean, look, the quicker policies issue, the quicker you get paid, which means the more money to invest in your business and more families that you help. So take your time on the applications and make sure you disclose stuff. I mean, look, we live in America. I love our country. I love our people, but people have health issues. If you're in your 60s and you're not on a high blood pressure medication, sometimes that's a concern, right? So take your time on those applications and disclose things. I'm not saying, I mean, you definitely need to treat some things like you're on trial. And what do I mean by that? So if you're working with an underwriter in the portal, just remember that they're people too, believe it or not, and they are on your side. But I had an agent where they didn't disclose that a client, a lead they bought, applied at another insurance carrier before that application. The underwriter said, hey, can you give us a little bit of background on why they didn't take that application? If that agent just said, oh, they like National Life Group better, they didn't want that policy, they could have approved it. But the agent got so defensive and they said, this is crazy. I don't know why this is taking so long. They got the policy and they didn't want it, or they applied for the policy, don't want it. They just got back from their doctor's office at the ER and they're as healthy as can be. The underwriter said, what? You didn't tell us about the ER visit. Now what's going on? So don't fish for things. That's not what I'm getting at. I'm just saying answer those application questions honestly. So these are kind of reasons when they're automatic knockouts. I have this from our underwriting team specifically around diabetes. So if you're diagnosed with diabetes after age 20, you can potentially be insurable with National Life Group. I know some carriers are 40, maybe 30. We're at age 20, but it's got to be well controlled and they can't have any of this stuff. So our underwriting guide is phenomenal. And I like tools because tools make dependent people independent. You guys eat what you kill. You're going to work weekends. You're going to work evenings. Don't get into the habit of having to call everybody every single time. The underwriting guide tells you a majority of things that you need to know. So definitely make sure you have that. And I can send all this to you guys after as well. But any underwriting questions before I keep going, whether it's for nationals, marijuana, anything at all, any questions that you guys have. So Heather,
Um,
if you're born with diabetes, you're a decline. After age 20, it just depends on the other factors I said.
And Devin, how about a cabbage that's 20 years back? I know they might have to be full med, but even on a full med basis on a cabbage, would you guys take that 15, 20 years back, no complications, in good health with good APS record?
Did you say cabbage?
Yeah, coronary artery bypass surgery
Oh, got it. Got it. Yeah, okay. Shows how hungry I am. Yeah. So yes, exactly what you said, man. Favorable APS and medical records.
all right, perfect.
I'll give you guys a general guideline. So 5 years or longer since things like cancer, heart attack, all those things, 5 years or longer since your last treatment, generally you're okay, but we will need to order medical records. I will tell you this, my company is caught up now. We are. So we had strategically switched assignments around. To let you in on a secret, we chose one of five agencies at the company, FFL being one of them, and we really honed in on improving your business. So we are getting more and more caught up. But you got to make sure that you're submitting good quality business with us. Otherwise, you might not be able to submit business much longer. That's not ominous. I'm just having a locker room discussion with you. I'd rather be sitting here on a call with you being happy that we're caught up instead of apologizing for our turnaround time. So we're not going to do that anymore. So just make sure you write good quality business. If you're going to get denied at a final expense carrier, we're not a last resort carrier. We've been around for 177 plus years and we want to be around even longer. And it's a good product. So we're not a company where you throw it at the wall and see if it sticks. That's not who we are. So just keep that in mind. Any other underwriting questions though? Anything at all? Nine is tough, Madeline. Nine A1C is tough, but again, it's a case by case scenario. Anything higher than 10, no. But remember, it's something where I could have diabetes with a 9 A1C and be fine, or I could have diabetes with a 9 A1C and smoke, so I'm a decline. So if it's ever one condition, depending on the condition, usually it's okay. But if you have a mixture of things, that's where it muddies the water. Nine should be fine considering everything else checks out, but 10 probably not. Good
Devin,
question.
I got a quick underwriting question as it pertains to marijuana. I
Mhm.
have clients at times that will be like, I smoke marijuana medically, or I, eat edibles to try to sleep with marijuana. It's legal in my state, whatever it might be. In that scenario, are you considering them a smoker, or how do you guys define that at National?
It's a great question. So it doesn't matter on the state. As long as you don't smoke it more than once a month, or it's no more than three edibles or gummies per month, you're a standard non-smoker with the company, and you disclose that. Keep in mind, case by case scenario. People argue, oh, it's medical. What's wrong? Like that's actually worse for you because you have a medical condition. But if you want to go to Colorado and have a great hike and take a gummy and have the time of your life, underwriting will look at that and make their judgment call. But no more than smoking once a month, no more edibles than three times a month. Tobacco, though, like dipping or smoking cigarettes, automatic tobacco user. We're just talking marijuana.
Absolutely. Got it.
Yeah.
Perfect.
Okay. Anything else on underwriting? Anything at all? Great. Fantastic.
No, you made it really clear too. I appreciate you.
Love it. My pleasure. So, oh, wrong button. So we have a trip at the company and it is free 99 to you at FFL. So if you get 180,000 in credits, and what does that mean in English? 180,000 in target, not annual premium. We don't go off of annual premium. We go by target. What is target? Target's commission. Last year we went to Hawaii at the Ritz-Carlton. This year we're doing Bahamas, and next year we're doing Dominican Republic. So if you have 180,000 in target from just January 1st to December 31st, then you qualify for our trip and you can bring a +1. I want everyone to qualify for this because they're so much fun and you truly experience the culture at National Life Group. People talk about the culture at my company, and I hope that you guys feel it, whether that's when you interact with me or our executives or anybody, and you really get that on the trip. And again, it's free for you guys, which is amazing. So that's our trip. Everyone can qualify. It's different if you're a brand new first year agent. So if you got contracted January 1st, then you only need, I think it's 110,000 credits January 1st. Just keep that in mind. But that's our free 99 trip for you. We are going to Croatia. That's a year-long qualification, and you do need 900,000 in target premium for that one. So Croatia, but still possible for a lot of you, I'm sure. So that's our trip. Now I want to talk about IULs for a second and kind of hone in on some frequently asked questions. So I'm going to start kind of simple and get a little bit more into the weeds, and then I can share anything else, whether it's illustrations or what you guys want to see. But there's a lot of social media experts out there, right? And I should have air quoted experts. Well, let's talk about IULs for a second. I'm going to talk about frequently asked questions. I'm also going to talk about how not to sell it. So, an IUL is not an investment. You can't legally call it an investment. It's a life insurance policy first, period, when it's all said and done. So, index universal life policies, I think, are the most underrated financial instrument in what we do. So, IULs are made to be funded for as long as you can, for as much as you can. It's pretty straightforward. The more money I put into these things and the longer I put the money in, the better it's going to be. Knowing how to structure them, as I said, is crucial. Let's talk about level versus increasing because there's common misconceptions with that. Level versus increasing. To keep it very simple, and this was literally on your state test when you took your state test. Level, my beneficiary only gets the death benefit when I die. Increasing, they get both the death benefit and the cash value. People think that you get both the death benefit and the cash value, and that means that the policy is automatically better or that's the better option. If there was a best option, only one option would exist. It's a case by case scenario. I'm going to give you Devon's opinion. Mid 30s and older, I generally lean towards level, generally speaking, general with a capital G. 30 and younger, I generally lean to increasing. Let's talk about why. Children, I'm talking teenagers and younger, I would almost always do increasing. They don't need the death benefit. They probably don't have children. They can benefit from the increasing option more oftentimes than not. When you're older and you have a level death benefit, if you're specifying your premium, the death benefit's going to be 3 times higher day one. So I know that clients could like the cash value, but if they die in the early years of their policy or have a living benefit, they won't be upset that they had a higher death benefit out the gate. Also, if you compare level to increasing for the cash value when you're in your retirement ages of 60s or older rather, the cash value generally isn't much different. Increasing might have a little bit more cash value, but you start out with a third of the death benefit with increasing, whereas level, you get 3 times the amount of coverage day one. Yes, increasing allows you to have earlier access to your cash value early on. I'm not a big fan of touching the cash value in my IUL. IULs are a marathon, they're not a sprint. Also, I say this last because it's the least important, and I would never train you on something, nor should you do something just for a commission, but level generally pays you more money as well. So if it's a red or blue car and the other car is a lot better, you're going to take the better car, right? So I said that last for a reason, but that's generally how it works with level versus increasing. Any questions on those two things, level or increasing? And again, I use generally like 10 times for a reason. Go ahead, Liz.
Liz, go ahead on mute.
So on the illustration, like when you can put you want it increasing, say the guy's starting at the age of 40 and you want it to increase until the age of 65
Mhm.
and switch to level at that point.
Mhm.
How does that figure in with what you just said about what they receive, what the beneficiary receives?
Yeah, good question. So, I'm glad you brought that up because whenever you illustrate something and you make changes, those changes don't happen on their own. So I'll use Liz's example, for example. So when I have a policy and I show payments going until age 60, and then I level off my increasing death benefit. That doesn't happen on its own. I don't care what agent saying, I don't care what agent is saying or what carrier is saying. That doesn't happen on its own. The client actually has to remember to call in and say, "Hey, I want to level off my death benefit and stop paying my payments." That's another reason why I generally don't lean towards increasing in some situations. But with that said, Liz, in your example, you have a client that had an increasing death benefit, and that death benefit was increasing for 65 until their age 65. They already have accumulated all that cash value and everything. So when they level off their death benefit, the death benefit amount would already have included all that cash value growth up until age 65. To keep it even more simple, whenever they switch from level to increasing, you already have had all that cash value. So you're going to receive that upon death. It's just that your death benefit won't increase by the cash value after you've changed the option.
Perfect. So any locked in gains are going to stay locked in, so to say, and just it will move over to a level at that point.
Yep. Yep.
Okay.
And remember,
Beautiful.
the illustration's your best friend. So it's one thing to talk about it. Don't dig this much into it with your clients because you will lose them, right? I compare IULs to hot dogs. I love a good hot dog, but don't tell me how it's made, right? Like that's IULs in a nutshell too. Keep it very, very simple. The other thing I want to talk about is indexing strategies. So illustrations will almost always default to the allocation that illustrates the highest. An illustration is just an illustration. So before I came a rep and went out into the field and traveled like I do, all I did was design illustrations for a year. It was the time of my life. Every day, all day, all I was doing was designing illustrations. I know how to manipulate them. I know how to change them. The only guaranteed thing about an illustration is that those numbers won't look like that. It assumes the same return every day, every year. Again, we're conservative with our rates and we underpromise and overdeliver, but it's always going to default to the highest illustrated rate. I said it earlier, the 4 or 5 carriers in the IUL industry that illustrate the highest aren't even top 5 in sales. I think one of them might be number 8. I'm not going to say who, but just because an illustration illustrates really high doesn't mean that that doesn't mean it's the best option. The most important thing is actually what's credited. When it comes to index allocations, and again, this is Devon's unpopular opinion, whether it's an index annuity, whether it's an index universal life product, generally speaking, in a high interest rate environment, which is what we're in right now, I really like the S&P 500. And when I say I really like it, if I got a policy today, and I hope you guys are kind of reading between the lines here, I can't tell you what you should put your percentages in. I always say next year, I'll tell you what you should have chosen today because there's no way to predict it. But generally speaking, in a high interest rate environment, I like the S&P 500. I would go 80% into the S&P 500 if I was getting a policy right now. The other 20%, I would put into something else. Why would I put it into something else? It's not having all your eggs in one basket. So I would put 20% to something just to put it to something. In a low interest rate environment, I like the targeted volatilities. And what does that mean? Just any other index besides the S&P 500. So if I ask everybody on this call who here has heard of S&P 500, everyone would know. If I asked you if you've ever heard of Pace Setter or all these other ones, no one would know other than maybe you read an illustration once, right? It's very expensive for a carrier to invest into bonds for the S&P 500, but we have it because it stood the test of time. But again, in a low interest rate environment, I like those targeted volatilities. That's why a lot of the targeted volatilities are not returning high right now. They are designed to perform well in a low interest rate environment. But again, index allocations are like driving on the highway. Let's say you're in 4-lane traffic and you're in a lane and the lane next to you opens up. So you move your blinker and you move over your car and then you try to get caught up, but the lane you were just in passes you. People see returns do really well and then they allocate their money to that return when the strategy that we're just in probably did better. Just like anything else, you're going to generally have 7 great years and 3 bad ones. That's how history works with stocks, with indexes, with anything. But high interest rate environment, I like the S&P 500. Low interest rate environment, I like the proprietary indexes. But what I like the most is splitting them up. There's not one option because there's not one best at the end of the day. Choosing your index allocation is just as important as structuring the policy, but 93% of applications just go through with what illustrates because I get it. It defaults to that in the system. So you'd have to actually change that. But the good news is on your smartphone application for your clients, you can simply just change it right then and there on your phone. So you don't have to call the company or do a form. Yeah, that's indexing in kind of in a short summary. Any questions on that?
So there's a question here. Can you switch your allocation down the road? I have my IUL with National Life Group, love it. I actually change my indexing all the time right on the app, and it's really cool. I don't want to say all the time, but I have changed it right on the app. So to answer your question, Paul, yes, sir, you can always change it.
Love it.
And
And it's
then
super
go
easy.
ahead, Devin.
No, I was gonna say it's super easy.
Yeah, it's like easier than like logging into like I don't know, like any portal. Like it's super super easy.
Correct.
And then another question Danya asked here is if they already have it at level and they pass away, the family doesn't get the cash value. Nope, they just get the death benefit. Is that right, Devin?
Correct. Yeah.
Perfect. Awesome. And yeah, we had quite a few people on a team that switched from other companies with, we won't say those names, to National with just the way that the IULs look and just a lot of the stuff that you went over today, I think it's huge, guys, when we can talk about a company that's been in business since 1848. Like, I'll wait on another one that's been, it's like life insurance company's been around for a long time, but being able to have a relationship with National Life Group and a company that does what they say they're going to do time and time again is absolutely huge. So this has been extremely helpful.
Good. I'm glad. I would definitely come back on too. I don't necessarily want to talk past the close either, but is there anything else that you guys have for me? Even if it's something we didn't talk about, we're huge in the annuity space as well. Also, yeah, Raina, go ahead. I hope I pronounced that okay.
You did. It was perfect. Um, I know that I'm going back to that same description about you saying the level death benefit, that's all they get, increasing, they get both. But I think I guess I got confused alongside with Danya's based on the example that Liz gave,
Okay.
because if they went from like say they were increasing and they were in their older 45 and they've had it increasing, they've been building all this money, and then they changed it to level and they died in their 60s. You once again, you're only getting your death benefit of that's it, just the death benefit. So all that money that they grew, what happens there?
Let's take a step back for a second, okay? I'm a
Okay.
very visual person, and I think showing the illustration might explain it. Thank you for bringing it up again. So let's run a quick illustration. So, by the way, always do LSW. Never ever do an NL product unless you're in New York. Never. You won't make that mistake twice because you either accept half commission or have to redo the application. So always do LSW. Always do LSW. But let's run an illustration really quick, okay? So we'll just say, I don't know, we'll do Bad Bunny. We'll make Bad Bunny a little bit younger. We'll leave him as standard non-tobacco, and then we'll go to death benefit and funding. So I know I'm going fast. It's just for the sake of time, but this is generally how you're going to run a majority of your illustrations. So if it defaults to something, it's probably for a reason. You don't have to change many options at all. I'm going to go ahead and click minimum death benefit max cash value. Believe it or not, it does minimize the death benefit to maximize the cash value. Most people pay their bills monthly, so I'm going to click on monthly. I'm going to specify the premium amount. So let's say that the client wants to pay $300 a month, and they only want to pay until age 65. But remember, this is just hypothetically showing them. So if you do the A, 1-A65, that's going to be age 65. If you didn't choose the A, it would be 65 years from now. But this doesn't happen on its own, on their own. You're only showing the client what it would look like. So let's leave it as level for a second, and then we're going to go to quick view. Excuse me. So day one, client gets $240,000 of coverage. They're paying $300 a month, and their target premium is your target premium is 2366. So just keep these numbers in mind with me for a second. So age 60, let's just call it 200 grand of cash value. My death benefits 240,000 respectively, and there's my commission. Well, Devon, I really like the idea of my client's beneficiary getting the cash value when they die because the insurance carrier keeps all this money. Not necessarily the case. It's how we assess the risk at the time of the policy. If you want the cash value and you want to do an increasing death benefit option, let's take a look at it now. So I go from level to increasing, and then my change year, which wouldn't happen on its own, but I'm going to show it increasing and then leveling off at age 66. Because I'm done paying premiums, I don't want my cost of insurance to continuously increase. My target premium goes from 24 to 800, right? My death benefit day one goes from 240,000 down to 90,000. Okay. So I get both the cash value and the death benefit. By the way, you don't add these two columns together. Net death benefit is the total death benefit. So I don't even reach 240,000 until I'm about age 56. If I go to age 60, my cash value is 220,000. So yes, it's about $20,000 more. And now my death benefit's 300,000. So yes, in this situation, at age 60, the client would get $300,000 in death benefit if they were to die, which is more than the level option. They do have a little bit more cash value with this as well. But again, your client's going to have to remember to level off the death benefit when they're later ages. And again, it depends on the client. At the end of the day, Bad Bunny is 34 years old. Bad Bunny could have no children whatsoever, so this is plenty of life insurance for him. Bad Bunny could and probably does have like 8 children. if you have no life insurance on your life, I know you like the cash value, man, and I know you like the idea of having both, but I don't want to go to your wife or your husband and only give them $90,000 when you die, right? So again, case by case scenario. But I hope that helps because by leveling it off, there's your death benefit now. You've already earned all that cash value, and that's thrown on your death benefit up until that age. I hope that helps clear things up.
That's extremely helpful, Liz. If you can let us know too if that was helpful, Raina. Yeah, that makes complete sense because guys, everybody's situation's a little bit different, and I think that's kind of what I hear you saying, Devin. Is that
Yep.
fair?
Yep, that's fair.
And yes, you can always change it. You go from increasing to level or right? Is that correct, Devin?
Yes, correct.
Perfect. 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 Awesome.
You can change
All
it
right.
once per year. Once per year, you can change it.
Perfect. Awesome. Anybody else questions?
Devin, real quick, just to clarify, when you have the cash value and you loan against it, not withdraw, you do a loan, is it true that the accumulated value is still getting the compounding interest compared to withdrawing it, where you'd be removing it?
Yes, dude. If I had a mic, I would say drop it. So he brings up one of the most powerful features of the IUL. If I loan out my money from a variable loan, sorry guys, if I loan out my money via variable loan, I still earn on the money I borrowed out, which is a game changer. So let's look at it really quick. So forget about what I'm doing from the illustration point of view. I'm just doing this to answer the question. But let's look at this. There's two columns, okay? There's accumulated value and there's surrender value. Surrender value, picture that as like piggy bank or savings account. That's your actual cash value of what you can touch. Accumulated value is the money I'm earning interest off of. So if I move forward to retirement age, this client's taking out $30,000, all tax-free money. My surrender value is going to decrease because that's my actual cash value. The accumulated value continues to increase because that's the money that participates in the indexing. So even though 10 years goes by and I've taken out $300,000 plus, I'm still earning compounding interest off of $1 million because the money loaned out still earns participating inside of the index. One of the best features.
That's a beautiful thing to see.
Yeah.
So
Beautiful,
do you
sexy. I
suggest
don't know what word you want to
going
use, but it's amazing.
It is. It is. Perfect. That answers the question, Devin. I appreciate you. This was powerful, and I think, guys, it just reiterates the power of an index universal life policy and just how Devin started it. It's flexible, it's bendable, but we have to make sure we know where to flex and bend that policy, so to say. So if we need help when we're writing these first few, that's the point, guys. Reach out, get help. It's not supposed to be all on your own. Just like Devin said, though, you want to make sure you have like that agent guide. It's like an invalid question or a silly question is like, hey, how can I write $1 million on a 30-year-old? It's like, hey, that information is right in your face, dude. Like, I love you, but read the guide. Another question is, hey, did I structure this properly and I need some help? Like, we want you to ask that second question. We want you to come to us, make sure everything's structured properly, make sure everything's good to go for the client. National wants that. We want that. Everybody wants that. So don't be scared to reach out for help, guys. That's what we're all here for. Devin, I genuinely appreciate your time and help today. It's been amazing having you on.
It's my pleasure. Thank you guys for all you do. I hope you have a great weekend, and I appreciate you. I hope to see you at the next convention and everything.
Absolutely. We'll see you there. Take care, Devin.
Bye, guys. See ya.